Hey, what's going on, Ronnie?
How's it going? How are
Doing
you?
good, man. Let's just just another day, another Thursday here in South Florida. Just gonna go ahead and talk about some stuff related to real estate. As always, we pride ourselves in keeping you guys informed and not influenced as far as giving you guys relevant information. And we found a cool article that we felt was worth sharing with you guys when it comes to mortgages. I mean, mortgage rates. And this one in particular
Yeah.
is titled "Why Do Higher Rates? What do higher rates mean for home buying?" Um, one big, I guess, takeaway from this is, and obviously I know you can talk about this, Ronnie, is when rates stay high, that impacts your credit card rate. Correct me if I'm wrong.
Yeah. Yeah. And I
Yeah,
think,
yep.
when they're talking about this article specifically, is talking about, the Fed's fund rate, which it's been obviously very in top of the news every time the Fed speak, are going to do rate cuts and whatnot. And, it affects the credit cards, sex, your savings account, and it kind of indirectly to an extent affects mortgage rates. So this is why it's kind of a great article that talks pros and cons, right? About when the Fed's higher the Fed's fund rate or lower the Fed's fund rate. What does that really mean? What's going on?
Yeah, exactly. And one of the cons, like you just mentioned, is unfortunately rates being high that impacts your overall credit card rate itself. So you're paying more on interest
Yeah.
as long as you're keeping the balance. But one pro is if you have some money on the sideline and you want to put in something safe where you can make some good return on, you could put them in CDs, because CDs, as of now, are at a historic high as far as you can make anywhere from, depending on what bank or what lender you work with, you can get a 1 year CD yield at almost 5%. So back to what Ronnie just said, you have your pros and your cons, and this is one pros as far as having rates still being high, where you can make a decent return, uh, low risk, high return as far as making some money on your money, and if you have any money on the
Yeah.
sideline. But
And I think on that, obviously the last few years, prior, people were making no money, when it was sitting in
mm,
the bank. And obviously for those very safe, you can make that 4 or 5%, depending on the banks have some specials. And yeah, that's, we're not used to that stuff. That's a pro.
now, but one con, I guess you could say, when it comes to mortgages, with rates being the Fed rates, excuse me, being where it's been at for quite some time.
Right.
In the case of mortgages, is this a negative thing, a positive thing? I guess it all depends on how you look at it.
So it's kind of, it's not 100% correlated when it comes to mortgage rates. So the
Okay.
reason why mortgage rates are high right now is because of the word inflation, right? Inflation, as we all know, whether it's groceries, insurance, car insurance, home insurance, it seems like everything has just kind of gone through the roof the last couple of years. So that made inflation go up, which is kind of driving where mortgage rates are at. So the feds are actually raising the Fed's fund rate to fight inflation.
Hmm.
So luckily this week we got, a CPI report, consumer price index report, that shows that, okay, inflation is maybe easing off a little bit. So just with that news this week, mortgage rates started kind of coming down a little bit, right? They're going in a better direction versus going up. Now they're starting to slowly come down. And anything like this, nothing happens dramatically, right? It's almost like a roller coaster. It goes up, goes down, goes up, and now we're kind of hopefully going down the hill where rates will start to come down. As you'll read in the news, hopefully, we'll see in the economy the inflation is coming down, and that will help mortgage rates come down. So that's kind of what the feds are trying to do. Them raising the Fed's fund rate was to fight the inflation, and now hopefully we're going to start seeing inflation come down, which, fingers crossed, mortgage rates will kind of come down.
And I'm glad you mentioned that too, because a lot of people, and you can't blame the average person if you're not really in that world. It's really hard for you to fully understand the role and the job of the Federal Reserve. They basically have a
Yeah.
mission statement. It's two things: keep unemployment down and keep inflation low, or I say low, but at a certain range. And that's their main
Yeah.
focus. A lot of people believe that, hey, since the Fed rate is high, it's impacting mortgages, and like you just broke it down, that's not the case. It's inflation, and their job is to what, tame inflation, or more so keep it at a certain range that's reasonable for the U.S. economy, man. It's not an easy
Yeah,
task.
they try to, yeah, they try to keep it at 2% is their goal, right? So have
Okay.
inflation at 2%. So as we start coming down, like the closer they can get to that 2% mark, that's when they feel comfortable. And another key thing you said there is unemployment. So I think if we start seeing the unemployment numbers rise, that between looking at the unemployment numbers rising and the inflation, those are the two 30,000-foot measurers that they're looking at. If inflation's coming down and if unemployment unfortunately goes up, then they're going to start cutting the rate. So obviously, if they cut the rate, bad if your CDs, right, savings account, that percentage will go down. But also that short-term loans, credit cards, all that sort of stuff should hopefully come down as well. And then mortgage rates will follow.
So what would you tell someone who's like, hey, I'm just trying to buy a house. I just need to get a mortgage. Should I pay attention to what the Federal Reserve is doing, or should I just kind of rely on the professionals to guide me?
Yeah, I think when you're ready to buy a house, you're ready to buy a house, right? You're buying it for a reason, whether it's growing family or you're tired of renting and want to own the property. You can't time the market when
Well
is going to
said.
be the best time to get the best interest rate.
Yeah.
So you just kind of, if that monthly payment fits fits your needs and you can do it, I'm telling my clients like, buy now if you can. You can always refinance whenever that time comes, interest rates come down. You just refinance into that lower rate and take that savings then.
And I love the way you put that too, because you can't time the market. And also, when it comes to buying a house, everyone's situation is different. There's a client of mine who actually has a job opportunity in Raleigh, North Carolina. They have a home down here, obviously, and they're saying, hey, now we're thinking about selling our home because we're going to relocate to North Carolina. So that's a prime example where, regardless of what the rate is, they know that they're going to sell the property that they have down here, use the proceeds or the cash to buy another property in Raleigh, and they can't time what the rate's going to be by the end of the summertime, but it's just life is telling them, hey, now it's time for me to A, sell, and B, buy.
Yep. And
Yes.
certain markets, every market's different. We always talk about local, have the local professional. And even right now, you can negotiate. Maybe there's, depending on the area, they have some negotiation skills you could do to maybe get that house at a price that's, maybe fair, right? And you kind of can get some incentives when interest rates come down, and whenever time that comes, that's going to dwindle away. So it's like you can always, again, refinance later that lower rate, but you can never negotiate the purchase price in 2 years from now. You pay what you pay for it.
You pay for what you pay for. Well said. Well said. So, yeah. So higher rates can mean a number of things like we just went over. Whether it's putting your money in some cash in a CD and getting a decent rate on that, up to possibly 5%, paying higher interest rates on credit cards. And at the same time, like Ronnie and I just mentioned, when it comes to buying a home, you can't time the market. So regardless of where the rate is at, it's more so where you're at in your personal life as far as where you're at in your as I like to say, your real estate journey. So all right. So outside of that, we as always we appreciate you guys' time. Stay informed and not influenced.
All right. Take care, everybody.
Appreciate it. Thank you. Thank you.